ladies and gentlemen, and welcome to this special debate on the distribution of financial products in Europe, a model in debate. With the retail investment package, the Commission's objective is to make the European Union an even safer place for people to invest their savings in the long term. But negotiations are still in process. The issue is highly controversial. The topic is hot, and our panelists are experts. It gives us the opportunity to raise questions about the model of distribution of financial products in Europe. To discuss this, I'm joined by Sandrine MÉNARD, Deputy Assistant Secretary for Corporate Financing and Financial Markets at the French Treasury. Welcome. With us, Maya ATIG, Chief Executive Officer of the French Banking Federation. We are also fortunate to have David CHARLET, that chairs ANACOFI, and we also have with us Jonathan LIPKIN, Director of Policy Strategy and Innovation of the Investment Association. Fannie WURTZ belongs to this panel also. She's head of distribution and wealth division of Amundi. Welcome. And followed by Guillaume, Deputy CEO in charge of business development at OFI Invest AM. Thank you so much for being with us. Maya ATIG, I'd like to start with you. Tell us, please, what do European savers need? You said when we prepared that they need a continuum of situations. What do you mean by that?
Thank you very much for organizing the panel with such a diversity of viewpoints. And thanks to Europlace for the great event, as every year. The Europeans, who are the Europeans? I think that it is the perfect moment to realize that there is a variety of situations, of choices. And when I'm talking about the situations and choices, I'm not talking about politics, but about economics. And if you take the average European, the level of savings that he has, the amount of savings that he has, is slightly above 10,000 euros. Of course, there is a huge variety of situations and of ages. And so, of course, in younger countries, France is among the younger countries. As you know, lots of countries have a challenging demographic situation. But in France, you have a diversity of people, some of them with long-term choices to make, because the young generation is a little more worried about its retirement than the older generation. However, we are far less concerned by the issue of savings for pensions than lots of other countries. So the continuum of situations means that you need a very diversified offer. You need a very diversified series of, I would say, channels of advice, because, of course, you don't have only one situation. And the problem is often that decision-making is made either on average or, which is far worse, on a situation which is not the average, which is the person deciding on the regulation or whatever, who is in her 30s or 40s and has to invest in products while understanding. And here again, for understanding, we have different situations with levels of financial literacy very, very, very different. And if I only finish, the last point of differentiation, of difference between countries, is the fields of savings, because it's difficult to compare what happens in France, where you can have a level of very, very safe investment through regulated savings up to like 1,000, more than 100,000 euros, sorry, for a family of 4 people, whereas in other countries you have no options for security. So we have all this, and we need to serve everybody if we believe that universality of access to services also applies to savings.
Thank you. Fannie WURTZ, can you tell us about the current model and the advantages of the current model from your point of view, please?
As Maya said, the average financial wealth in Europe is 10,000 euros, so pretty low. It has good reason for that, is that historically, actually, in Europe, the states were organizing retirement for most countries, and the financial wealth or the wealth of investors were in real estate or in cash deposits. Our universal model, which is a universal bank or universal insurance, is enabling every investor to benefit from the best advice wherever their amount of wealth. And this is a model that we need to preserve. Meaning that when an investor or when a client is entering into a branch, meeting his advisor, whether he's going for an insurance, whether he's going for a mortgage, whether he's going just to make savings for his retirement or to save for his kids or for, I would say, a bad moment of his life, his advisor will give him the best advice because he is unbiased. That model has some, I will say, criticism for some of them, saying, okay, but let's look at the bank deposits, 50%. And the limitation that often are criticized is not linked to the model, but is linked to other factors. The first one, as Maya said, is that the financial education in Europe is very low. Let's face it, we all wish it would be higher, but the average financial education in Europe is less than the average financial education of OECD's countries. And there are plenty of disparities. Unfortunately, I'm French, and the financial education in France is below OECD. So this is a concern we all have to start tackling. The second point is that, frankly speaking, it's complex when you want to access capital markets. You have a lot of administrative burden. You need to have PRIPS, you need to have best interest, you need to have sustainability tests. This is complex. This is good because it wants to protect the investors. But if you add financial complexity and low education plus complexity, people start to get lost. The third element is also that we need to be clear, retail investors are investing in financial market when there is a tax incentive. And this is what works well. And the more tax incentive we will be putting to redirect to financial markets, the more savings there will be. At the end of the day, our universal model is enabling each and every investor to benefit from the best advice, independent from its base and from its wealth.
One more question for you, Fannie, if you don't mind. Jean-Charles Simon, Managing Director of Europlus, gave an interview yesterday to Finascope. He said the retail investment strategy is disconnected from the financial sector's competitiveness objectives. To understand what's at stake with this text, could you elaborate a bit on that, Fannie WURTZ, please?
First of all, let's be clear. Retail investment strategy has good intention. At the end of the day, is to protect the retail investors. But it has two limits. The first one is that putting a ban or putting a restriction on the inducement will actually raise some issues. The first one is that it will disrupt that model where everyone will benefit from the best advice independently from its wealth. And I'm very happy to have Jonathan close to us that can also give us a feedback after 10 years of, I will say, inducement ban in the UK, and where we obviously are observing all an advice gap, meaning that in the UK, after 10 years, if you don't have minimum of 100,000 euros of wealth, you don't have any more advice. Maya just said that the wealth average in Europe is 10K. How do we tackle the majority of our population that don't have that financial wealth to be able to benefit from advice? The second, I will say, limit to our RES is the cost centricity. It's good to focus on cost, but cost cannot be the sole driver. Once again, when you're a retail investor, when individual investor, you need to make sure you have the best advice towards what is your challenges. Start first with what is the client needs, what is the investor needs. Cost, and focusing only on cost, will prevent to obviously tackle some of our challenges, like green transition, where making ESG or sustainable product, and we listened to the previous panel, is much more costly to manufacture, or as simple to finance the real economy. And obviously, financing private assets is also more costly to maintain. I will stop here, but we can also link it to the financial needs of Europe. I'm not sure that focusing on cost is the right debate we should have in Europe right now.
Thank you. Jonathan, you are a British association with a European perspective. You members collectively manage £8.8 trillion on behalf of clients in the UK and around the world. And in the UK, you have gone through a lot of changes that have been discussed in the retail investment strategy. So you can draw lessons from what you see working or not in the UK. Can you make a general point, please?
Yeah, great. Well, it's terrific to be here. I come from a retail regulation laboratory called the United Kingdom. Over the last 10 years, we have gone through incredible change from something called the Retail Distribution Review that I'll talk about in just a moment, to a series of formal competition, market studies, and most recently something called Consumer Duty, which is also very relevant to the discussion today. And we've also automatically enrolled 11 million people into pension savings. So all of those things give us a perspective that we're very interested to share as we see the retail investment strategy. And I'm very struck by the discussions today, which are seeking to balance the sort of core perspective in the strategy, which is participation and making sure that people really are included, as my colleagues on the panel have said, with this perspective of safety, which of course is important. So let me just try to draw some conclusions in my remarks from what has been a very busy period in the United Kingdom. The first point I would make is that it's very tempting for regulators to use market structure solutions to solve problems. And what I mean by that is it's an analysis of the different incentive structures, the way in which products are delivered, and then a set of solutions that appear to give you what we call the Holy Grail, that if you change incentive structures, if you change the relationships between different parties in the market, if you make fees more transparent, then the market will improve. And let's be clear, many of those interventions are valuable. But what we have seen is that there are unintended consequences, and that actually market structure interventions do not solve the problem that you started with. And we can see that very clearly with the Retail Distribution Review, where we do have better quality advice now available in the United Kingdom. We do have more transparent fees, but we don't have the access to retail advice that many millions of UK citizens need. And similarly, when you look at other interventions, both in Europe with the PEP, for example, which I've been very closely involved in, and in the UK, where we've gone closer into product regulation, for example, using charge caps or very specific economic requirements, what we see is that a well-intentioned policy does not result in a functioning market. As we heard from Verena Ross this morning, we only have, I think, one PEP in Europe. And it's not to criticize the safety aspect, but what we have to do is get the right balance between safety and inclusion. And my view is that we're not in that place. And just one final point on this concept of price and the relationship between price and value. There is a great danger of confusing price and value in the debate about the future of the retail market. Of course, there has to be high levels of competition. Of course, customers have to have access to the best possible product for the best possible price. But the clue is in the first part of the statement. What is the best possible product? And we are in danger of leaving that first question and moving straight to a question about price, which appears to give us the right answer, but actually won't. So in conclusion, market structure interventions can work in some ways, but actually what I think we're talking about is changing behaviours. We've seen some of the most successful intervention in the UK in behavioural change behaviours in fund management companies where firms tell us that they're comfortable with the assessment of value assessments that they're doing internally. It's changed their way of thinking about how they serve their customers, but also behavioural changes in the retail market. And that goes to your point about incentives. It goes to the broader point about how do we make sure that people can actually feel included. So I think there needs to be a broader set of policy tools deployed, and I look forward to the rest of the conversation today. Thank you.
Yeah, one more point. If you talk about the use of benchmark, if you may, that can help behavior. We talk about structural possible potential changes. Is it really possible to change behaviors of clients, even with the base structural changes? Can you see the impact in on the UK market?
That's a great question. I think that it is possible to see changes, but you have to be very clear about what you're trying to achieve. You can't achieve it with the conventional toolkit. You can't use highly regulated advice and expect people to respond in the way that you might expect. In other words, a willingness to go and pay a flat fee where actually what they might want to do is come and have a different kind of conversation. And so where you're able to facilitate that different kind of conversation, behaviour does change. Similarly, behavioural economics tools are very powerful. And this is something that I think we probably are going to talk a lot more about in the context of the Letter report and the Noire report, because possibly the biggest policy success in the last 10 years has been automatic enrolment. And it's changing the way in which people behave by trying to help them to do something that they might otherwise not do themselves.
Thank you. David CHARLET, as chairman of ANACOFI, you know very well the French system, but also the Canadian system. Really interesting to refer to international experience. Could you describe us these systems, please?
The Canadian one or the French? The Canadian?
Yeah, both.
Yeah, both, yeah, in fact. Yeah, in France, we've got a quite good system because it's balanced one. In one hand, we are forced to propose advice. It's on the market. It's impossible to offer a product without advice. Okay. In the other hand, you can be paid the way you want. So by fees or commission, 60% of the advisor propose fees. But in fact, they earn their life 80% through the commission. But you can choose. You are, as client, you can choose. As an advisor or intermediaries, you can choose. Another aspect is that in France, we've got some certification to obtain. And they're numerous, but not too much. And this offers me to have a link with the Canadian system. In fact, in the Canadian system, it's quite easy. Okay. Ban on commission? Absolutely no. Ban on commission for a financial planner only. But you can add any certification you want. Real estate, broker with many level of brokers. So the first level can just offer some, let's say, a pension plan or things like that, collective funds, things like that. In it, at the end of the end, with another certification or graduation, it's linked to sort of graduation. You can do everything you want on securities and funds. You want to look like an asset manager? Yeah, you can. You can add a lot of certification. It means that it's perhaps more complex if you want to product the full advice, let's say, well, we call it in France conseil en gestion de patrimoine. Okay, if you want to offer this sort of service, you can go further than in France, far further. But you need much more certification, and with each certification, you've got constraints. So you've need rules. But the thing is that the regulator, it's, well, let's say, it's more quiet. They do the job, but in fact, they do the job in a way much more friendly than in France, for what we understood from the profession, from the firms. So that's it. That's another model, but it's absolutely false if we say they have a balance commission. Absolutely no. Balance commission for people explaining to other people that they are financial planner only, basta. So
the French model is the best.
It's probably a balanced model, and if you have a look to other country or state member in Europe, where the market is a good market, and for example, yes, take a very different country, a state member, sorry, Czech Republic, they've got the same sort of job, the same offer, and what is the model of Czechs? They can choose fees, commissions, they can be advisor or not advisor. It's not far from our model, but with only one advisor, there are digitals, more digital than what we are, that's true, but in fact it's the same job, and mostly the same way to be organized.
Thank you. Guillaume Paoli, you are the Deputy Managing Director of OFI Invest Asset Management. Maybe a small introduction of your company, and tell us please, what is your diagnosis about distribution in Europe?
Well, thank you, Fabienne. First of all, thanks to all of you for attending here. We have strong competition from the other roundtables, so you're true heroes and friends for attending, and really appreciate that. Secondly, to answer your question, yes, OFI Invest usually is not a very well-known company, so I won't spare you our introduction. We are, we've just became the 5th largest asset manager in Europe. In Europe, I wish. In France, yet. We've tripled in size over the last 3 years, which explains that our brand is mostly unknown, but we're working on it. And another particularity is we are 98% of our assets, the origin of our assets is French. So we are the less international of all asset managers present here and probably in this room. So that gives us a lot of opportunities, of course. That also gives us a lot of appetite, and that leaves us thinking about our international expansion strategy, particularly in Europe. And here, I'm not discovering the subject today, let us state that Europe was not built in a day, really not. What has been, I think, outlined by Maya and by Fannie is the actual amount of local idiosyncrasies of each European market, which is due to a mixture of tax and regulatory reasons, and the fact that in spite of fighting probably I would say the common competitor, which is outside of our continent, not in the UK, I'm not being unfriendly. I'm thinking slightly more abroad. Instead of uniting ourselves for that specific battle, we spend quite a bit of time in each country preserving what we have and holding on to our old habits, which means that for a French asset manager looking for expansion, the usual framework of free circulation of goods and services in Europe and level playing field conditions is not really the point of the matter. The point of the matter is how do you actually cater for local idiosyncrasies, and can you do it by yourself if your brand is unknown, and if only part of your catalogs of goods and services is going to be relevant. Well, there is 3 methods. The first one is you take the plane, or preferably the train, to lower your carbon footprint. You take the train, you go and sell. You go with a little briefcase, you go and sell your products. That's long and difficult. Or the second one is you look for a local partner who knows the local idiosyncrasies is gonna plug what the way they tackle their own market. Adapting your own offer. Or the third one, and I think you know something about that, is you make acquisitions. So the model in debate for us as an asset manager, and I'm aware I'm giving the asset manager perspective, not the distributors, is the local markets are so local, and they are not going to change in a day. If you want to accelerate, you need partnering locally. Don't think that products can be sold because they're good. They have to be good in a specific place. You want more? Or?
Thank you. Yeah, one more question for you, Guillaume. You told me when we prepared that asset management in Europe remains a cottage industry. So that's what you mean, that consolidation is needed?
Together, earlier on, we were discussing 800 asset management companies. You might think this is the number of European asset management companies. It's actually the number of French asset management companies. You have, and that's a growing number. So that's what I call a cottage industry. If you look at three, similarly, apparently comparable industries in the world: asset management, investment banking, and cloud computing. One of our very famous competitors recently made that comparison. They said, "What is the global market share?" So talking about the global markets, not only Europe. What is the global market share of the top 5 companies in asset management? It's 10% of the global revenue. If you take investment banking, it's 32%. If you take cloud computing, it's 74%. So that industry has low cost of access, low returns as well, so you can survive for a long time. You put 2 people and a dog in a garage, and you have practically an asset management company that can survive, thanks to the fact that costs are not yet entirely smashed by competition. So there is low competition, high survival rate, and lower incentives because of that localism, if one might say, that survives in Europe. So concentration will come. We as a company think we'll be part of that, but you need to do that where you feel comfortable and define your targets quite precisely. But that is still a cottage industry.
Thank you. Sandrine, MÉNARD, and sorry if you are the last to speak in this first round. It's not because you are a woman, of course, it will be rather a strength for me, or because of you are from the prestigious French Treasury, but I wanted you to listen to the different players. And so this subject of RIS is quite controversial. Negotiations are still going on. What does determine the French position? Could you tell us a bit about that, please?
Thank you, Fabienne, and thanks to Olivier and Paris Europlace for hosting this event. It was great actually to listen to all of you, and I've heard the various points of view. At the same time, I think the common concern to have successful incentives for the economies, the savings of Europeans to be invested more in the real economy. For avoided unintended effects of regulations. And I think this is something that we very much share. And also for taking into account the specificities that we have in the EU on the distribution of products. And in France, we hold very dear the territorial presence of physical advice and the quality of advice. We're not so digital, as has been said. It will change to some extent, but for sure the position of the French authorities on this file is to find the right balance between making sure that we have the right incentives in terms of cost performance ratios, and at the same time not disrupting this model of the universal banking, as we call it in France. So yes, negotiations on the retail investment strategy are accelerating now, in spite of the current political context. But it is an issue on which tomorrow there is going to be probably important discussions in the Council. And I think that after months of hard work on a proposal from the European Commission, which was very difficult for us to work on at first, because let's say that the level of control and of unintended consequences was quite high. we are converging towards a lending zone, which will still require working with the next European Parliament. So it's still going to be a debate for some months. Huh? But what we see now is a lending zone where basically there is no
Can you make the micro closer, please?
When there is no ban on inducements, as this was really the important point of entry for us in this discussion. And we were, as France, the most outspoken against such a ban because of its unintended consequences. But at the same time, there is an attempt to really add on to the incentives for a better value for money in European savers and for European savers.
Thank you. I don't know if one of you wants to react. Otherwise, there is another point I wanted to stress, Mayatik, for example, with the European text today, the distribution of financial products might be affected by the complexity of the documentation to be provided. So people may be drawn in information. Is it something that you fear?
Well, you know, when you put an animal in boiling water, at some point, will the animal die before he realizes that he's dying? We don't know. So I think that here complexity is something which can be very reassuring in terms of policy making. Okay, let's add a test. Let's add questions. Let's reassure everybody on the fact that he understood what he had to understood. And so you add up questions and you add up internal processes. And we are here victims sometimes of ourselves because we are very creative in creating controls, creative as very regulated entities in all industries. I'm not only talking about banking industry, but the advice industry, the asset management industry. We are all very good pupils. And so, of course, you are piling up things. And on the other way, you see, of course, lots of people going outside the system, going to digital networks. But in general, it's, of course, because it's user-friendly and the experience is nice, and there is a way in asking questions which can seem friendly, but which is not thorough in general, or which is dedicated to people who are used, I would say, to play with the okay. You know, in general, when you file questions on the internet or on your apps, you are used to tick very quickly the boxes. And so does that mean that you really understood what you're doing? It's not sure. So all this complexity is something which is deeply rooted in the way we're functioning, and we are not trying to find a better balance and to come back maybe to 15 or 20 years earlier when questions were simpler, but also the processes more fluid. So this is very important. And another point on the viewpoint, on the other side, which is the investment side. I'm always very surprised. Sorry, I will just very quickly pass it on to you, but I'm very surprised by one point also. We talked about the diversity of investors, but we also need a diversity of asset classes, and we need, I mean, for 15 years, I've heard the national authorities, economists, policymakers, requiring investment firms, insurers, to diversify their investing options, to be sorry because there are no SME analysts in asset management companies, and there is no way in investing in smaller companies, etc. And investors are not making enough efforts. But if the efforts that you need to make in order to find I would say specific asset classes or specific investment choices is not in line with the fact that the questionnaires lead you to very, very, very simple investments, then there is a big discrepancy between the asset side and the investment side.
Thank you. Guillaume, I think you wanted to add your point of view.
Yes, just a quick remark based on what you just said and what Fannie was alluding to earlier on. We're all deploring a lack of or low level of financial culture for the public in general in Europe. And I think this is the reasons why, you know, these are good reasons in their intentions, probably not very well deployed in terms of results. This is the reason why there's so much energy and effort put by regulators into trying to compensate for this lack of financial culture, in making sure that people read 25 pages of documentation so that their lack of financial culture is going to be compensated in, you know, 2 hours of reading, if that ever happens, and people can then, knowing exactly what they're doing, make their investment choices. Unfortunately, it doesn't really work like this. And that leads me to the other point, is we are discussing the merits or non-merits of the use of digital tools in the dissemination of products and the education of the public. It strikes me that in Europe there are no digital player that I know of. If someone can actually know me, a significant digital player in the world of savings in Europe, I would have learned something today. There's just no one. And the reason is obviously different cultures, not the same languages, high barriers of entry for dissemination of that. But there is, so that's very complicated, but you can see that in some instances, when there is really the commercial need of making things understood for people so that they can make their choices, miracles can happen. I have in mind, and I won't quote them, I have in mind digital companies in France which are offering a certain types of savings, épargne d'entreprise, let's call it this way, which make it genuinely understandable and properly acceptable by a regulator to understand what people are actually doing with their money. It's marvelous. And I think one of the ways regulators should really incentivize, push, I think, market actors is really to use more of those tools. Those are actually the way of understanding what people are doing with their money, which is at the end the point. Part of the regulation, rather than being considered as purely a commercial act. Did I make myself understood? I'm not sure.
Jonathan, you wanted to add something?
Just, I think Guillaume made the point really well. I mean, I was just going to say there's a critical question that is missing that must go in customer communication, which is it decision useful? And that might seem like a really obvious point, but our view is that we've lost sight of that in the policy debate, because the question has been, can we make the industry fully transparent and trusted? And of course we should be fully transparent, and of course we should be trusted. The point is that you don't do that through a 3-page A4 document with information that no one understands. You do that through the wider culture, through the behaviors, and then you have something that you can put on your phone that tells you in terms that you understand, and then it is decision useful. We need to urgently just put that as a question every time we look at any proposal, including our own.
David Chalet, yeah?
Yeah, sure, to react. Yeah, sure. The point is, you talk about financial education. And we are always explaining that people are not enough educated. So, but we forgot some things. A great part of the population don't care about our jobs, our finance, and things like that. So those people must be helped by the advisor, or let's say the sailors when they advise. Because one part of the population in each country will never try to have any level of financial education. That's the reason why we have advisors. It could be digital or not, but in fact, one part of them don't care about their own financial education. They do the job. At the end of the day, they have a dinner, and after the dinner, they do something else. Basta.
Sandrine, you wanted to answer?
Yes, thank you. No, just on this point of financial literacy, from the point of view of the public authorities, there are things to be done. There are things to be done in the education system, that's for sure. And there is also, and we are in France, and in France, people believe in you know, the political momentum and action. I mean, you were referring to the Noyer report. What among the proposals that are in the Noyer report, one is, I think, very important also to foster this investment in the real economy from the wider public, which is the idea of having a pan-European savings product. And it's certainly a tool for financial literacy. The idea is that by showing that several European countries push at the political level to develop such products,
can you speak in the
long-term, non-fully guaranteed products, invested mostly in the EU economy, but at the same time, which benefits as a counterpart from very interesting tax treatment. This is certainly an initiative from which we expect a bit more trust in investing in the real economy and perhaps a bit more interest in what's behind.
I'd like to hear Fannie's reaction on this, please.
Actually, you're making a very good point, and it also, can you hear me?
It's okay.
And it also relates to the financing needs of Europe. If I look at what we have to finance in Europe moving forward, we have to finance a green transition. And the European Commission said the green transition is about 750 billion per year. We have the retirement of our populations to finance, we all know that. We've got a digital transformation, and we have a real economy to finance. Our states are indebted, we all know, and living in France, we lived it for the last few days. And actually, the asset management industry is a tremendous industry to redirect and to funnel a long-term investment as we're investing for the long term, as we are managing the savings of retail investors. Where we are now, the share of the European asset management has lost 10% in favor of US asset managers in Europe. And US asset manager in Europe represent now 40% of the asset management in Europe, whereas European asset manager in the US are representing 1.7%. Whenever it's about US asset managers, they have a US bias, that's normal, that's for sure. And if you look at the weight of US stocks into a world benchmark, it's 70%. So if we don't channel rightly the savings of European investors to manage our European transition, we will simply miss it. And you were referring to the Noyer report, which is also saying that 20% already of the savings of European investors are financing companies outside Europe. And if you look at the LETA report, 300 billion per year of the European savings are financing stocks outside Europe. We will be delighted, and we are talking about the distribution of financial products in Europe. But we also need to have our governments to help putting the right tax incentive to make sure that European savings are financing the European, I will say, economy, and that the European management industry at some points is funneled to redirect that economy. And by focusing the debate only on cost, not into the best interest of the clients, not into the best interest of European economy, and not putting the European, I will say, sovereignty and the financial sovereignty of Europe at the core, I think we are missing part of the debate.
Maya ATIG, can we hear you on that, please?
Very simply, I have a survey here that we do every year on the first priority for savings product according to the French people in general. No? So for half of them, it's a low-risk product with a lower return. And I would say that those people, half of the people, it's basically the people who have, of course, very low savings, but not only, because this is also, there is also a high answer in this item, in the category of people who have savings. 20% is the development of local communities and creating jobs. 16% is financing the transition, environmental transition, and 14% of the people is a riskier project for a higher return. So basically here we have different strategies, a different appetite for risk, of course, but with a level which is very much skewed to low risk. And so there is room for advice here and for proposing different choices, but since we have in France a framework which directs a lot of savings towards low risk, it means that you need to make far more efforts for the people to invest in other universes. And you need also to make far more efforts to find the good investment opportunities for that. So all this has a cost in the end. It has a cost which has to be paid at some time during your life cycle. So either you pay it at the very beginning with a huge increase in interest for financial education, or for, I would say, making people greedy and with a high risk appetite. Or it means that you pay it all the time with lower investments towards riskier and more innovative products. It's in fact a story of lifestyle and of life cycle, for savings.
Jonathan, do you want to add something on the discussion?
If I may, just to come back to Sandrine's point about the pan-European savings product, and to pick up some points that Fannie was making. With a European hat on, I've been working with our European Federation on the concept of a pan-European pension for so long that I think I had hair when we first started, and we're really committed to making this work. And my one plea as we think about the next generation is that we learn the lessons from why PEP hasn't worked, because it was almost what we would call a textbook example, where we start with the concept of the default investment strategy, good, but then we're going to have fully regulated advice, okay, and then we're going to have a charge cap, and we have this expression in English, the safety of the graveyard, and there is a real risk that you go just too far the other way. And I think there's a great opportunity for us to see why that didn't work, to get the balance right, but also to Fanny's point about the risk. Sorry, Maya, I got your name wrong. About taking more risk, that we just get this right.
Sandrine, maybe we can come back and tell me to what extent is the issue of the retail investment strategy related to the role of the CMU and the banking union as tools of stability and resilience for the European financial system?
That's a tricky one. Maybe to make the link with Jonathan's point just before, well, we are trying to draw the lessons of what we didn't manage to launch as an impetus with the PEP. Probably the key was the tax, the lack of an agreement on tax treatment at the European level. And this is why this time, for once, we're not relying on a European legislative initiative. Of course, it's a European initiative, but legislating on tax, as you know, is an object of unanimity in the EU. So this is why, for once, we are proposing to start with a bottom-up approach in a way, with a few like-minded member states. And because the tax point is key, but we need to have something substantial there. Is the retail investment strategy a contribution to CMU? Well, it has to be, because CMU is clearly a high-level objective that we share for the reasons that were mentioned, and it's really I heard the CEO of a big bank today saying it's one of the key boosters for growth, and it's certainly something we subscribe to. So we have to succeed, and the retail investment strategy has to be seen in a very pragmatic way with respect to this main objective. So first, it should avoid going in the opposite direction, and secondly, let's work to make it part of the positive narrative towards capital markets.
Thank you. Guillaume, do you want to react at what you have just heard from the position of the French Treasury?
Regarding capital market union, I think you mentioned at the start, but I'm sorry for really insisting on that point. But if the tax point is not solved throughout the countries that want to participate, if it's not solved positively, because there is a harsh way of solving it, which is making every other investment more taxed than it is today, and only preserve that one, which, you know, I wish maybe I would never have suggested this, but that's a very bad way of doing it. But it's very difficult to make it a positive incentive throughout Europe, and that is absolutely key if you want that to be a success. Otherwise, it will be seen as a new form of tax. There is a real danger there that it is seen as a compulsory investment and actually is a tax. And people tell you, okay, some of your money that you have earned this month is gone into those investments. Don't worry, it will come back. And by the way, it is financing wind farms in Estonia and other places in Europe. But it's a tax, actually, because you never know when it's coming back. It reminds me, when I hear that, about the old, and that will only speak to the historians of French savings, the old emprunt Pinet, which fortunately enough ended in a positive way because the way rates change over time made it entirely rebuyable by the French Treasury, so we avoided a national catastrophe here. But you know, it has to be a real and a genuine incentive in terms of tax. Sorry, I'm being heavy.
David Charlet.
Yeah, but tax is something very important. You can see it in Netherlands. You understand that their wealth is made of real estate, their home in fact, and by pension plan. And the question is why? And the answer is quite simple: tax exemption. So in fact, there are one of those only 3 countries in Europe within or not EU with a better level of life after they retired than before. But in fact, it was paid by the tax. But the tax, it means that the state has the money for that. So, but what is the case in France? We don't have the money, so we can give it to. So, with the tax, you see that you can bring people to invest in something for sure, absolutely for sure. They have accepted to be less rich when they worked than where they retired. Yeah, sure, with tax. But in fact, if a financial planner, let's say that in English, will help people to organize such a wealth in France, he will be in jail because it's absolutely compliant with the European rules, regulation of ESMA, EOPA, and so on. With no advice, you can do that with the tax system. But with an advisor, you are in jail.
I don't know, Maya, I think if you want to add something, and also you did with David Charlet an interesting comparative study with KPMG a few years ago of the different existing remuneration models in Europe. I'm sure you can draw lessons for a discussion.
Yes, well, the lessons that we draw from comparative studies between countries, between model distribution for savings, in fact, shows that if you want to calculate average costs, then roughly all the systems cost the same, basically. It's not, the difference is not very significant. The differences come from other considerations and from other effects of regulation and of the organization of the distribution model. The differences are the access, so the advice gap. So in fact, it can cost the same everywhere, but it doesn't serve the same people. So this is a big difference. If in a kind of distribution and remuneration model, you have people with, earlier I said that in France you can, for a household with 4 people, 2 adults, 2 children, you can invest up to 120,000 euros, tax-free, risk-free, with a very, very big liquidity. Which means that over this amount, you start to discuss about riskier investment. And in fact, and today it means that for the banking industry and the asset management industry, and of course the distribution through financial advisors, you can address people with lower levels or with levels just above this 120,000. And so who have maybe 10 or 20 or 15,000 more euros to invest. If you look at other models, especially the Netherlands and the UK, then the threshold for serving clients with advice is this famous 120, which means that you exclude from the scope lots of potential clients, lots of households, which is not, I would say, which is not our vision in general, because we are a mass market, basically. The other big difference is also the distribution of fees across these households. In one case, you have a proportional cost, and in another case, you have something which is more, I would say, rough as a situation. And so you have people with a lot of money paying roughly the same as people with not a lot of money, which of course also excludes people from all this. So generally, when there are these discussions about policy, about savings, it is conceived as a very subtle balance between many tools, but in the end, adaptation is about who you serve, how you distribute the costs, and what is the service, what is the cost that you're going to put at work to deliver this service. So these 3 parameters still need a lot of reflection for the retail investment strategy.
Thank you. Fanny Hurt, we come to the end, and is the ARS going to be implemented at the expense of European retailers at the end? This is something we can still fear.
I'm not sure that fear is a good word. And once again, our ARS has actually good intention. We just need to be clear, and Jonathan says there is a difference between value and price. And there is a good price if there is a good value. And at first, I think we all been missing the first point is what is the best interest of the client? Acknowledging that when a client is entering into a bank, he's looking for his advisors, looking for the best advice on whether can I buy my house now? Do I need to save? Do I need to buy an insurance? And the fact that the advisor is unbiased, because whatever he will give to the client, the remuneration systems makes it equal and fair, is something that protects the investors. And if our aim is to make sure that all investors get the best advice, independently of their wealth, towards all of their life journey and financial life journey, and that we also all agree that in Europe we've got massive financing needs, we need to make sure we make the whole ecosystems work in the best interest of our European economy and our retail clients. Both can be conjuncted but we cannot oppose both of them.
Thank you. To conclude, Sandrine, Ménard, do you think that the way that the package is discussed today and this week can address the different problems that we raised?
Well, the quick answer is that we still need to work, even if the intentions are good. But I fully agree with the way Fannie just described what is at stake and the importance of value, first and foremost, and the key importance of financing the economy. And I think there is a broad political consensus, or at least, I mean, in the current political setting, there is a consensus about the fact that more can be done to finance more the European economy while really serving the client's interests, whatever their level of revenue.
Thank you. Well, the new rules aim at enabling the citizens to better navigate financial markets and build on new digital financial trends, give additional tools to supervisors to act more efficiently and preserve the competitiveness of our companies. Will the goal be reached? Not everybody agrees. Anyway, I think we can thank my panel and that tried to contribute to the debate. Thank you.